Today's video is going to be extremely important. It's about profits, and it's about what makes up profits. This is not a difficult concept. People with grade school education can grasp it, and yet I've seen people with PhDs just couldn't get it. So let's talk about revenue, expense, and profit. What are they? And why should people make profits? And what are not-for-profit organizations, and why do they exist? There are two things that make up profits. One of them is revenue, and that's money that comes in, and there's expenses, that's outgoing money. So it's just that simple. Revenue is income, expenses are outgo. The definition of revenue, the money a company takes in as a result of its normal activities, that's very important. It's also called income. So your firm sells a car for $30,000, your shop sells a haircut for $25, someone pays you $25 for 1 hour of work. Those would all be income. What it is not is if a car dealer sells a piece of land. That's not income for a car dealer. That's outside the scope of their business. Not a restaurant sells a delivery car. That is not income. It's something else. We'll talk about what it is, but it's not income. So many business owners go broke because they confuse revenue with profits. They think that, oh, all the money coming in is money I can spend. Yeah, not. It's just not. Expense is the cost of operation that a company incurs to generate revenue. Now, people say, yeah, you got to spend money to make money. That's true, but there are limits on that. A lot of people go broke saying that. Or the cost to obtain a necessary resource. It's outgoing money. You pay a car salesman $1,000 in commission. You pay your landlord $4,000 in rent for your shop. You pay someone $25 to work for you for an hour, or you buy office supplies, pens, pencils, paper, whatever it is. So what are not expenses? Well, this is kind of tricky because it depends on what the law allows. If you have any questions, you want to go and ask a tax person on that. In words, revenue is money coming in, expense is money you pay out, and profit is what's left over. So you have your money coming in, whatever it is, expense you pay out. So someone pays you $25 for a haircut, expense, you pay your worker $5, you pay rent, whatever, and the profit is what's left over from that. Revenue minus expense is profit. And this is extremely important. A lot of people get this wrong. They get confused and they blow it. So you always have to ask yourself, what are you spending? How much am I spending on this? And what's the true cost of what you're spending? The $5 you pay your employee isn't the true cost of that haircut. What are you getting back for the spending? That's also an important question to ask yourself every time. This is the way most accountants learn this. Profit equals revenue minus expense, or P equals R minus E. So over here we have profit, revenue, and expense. We'll repeat this one more time because this is extremely important. Really have to know this to stay in business. Profit is the money left over after all the expenses are paid. Negative profit equals loss. Yes, that's a bad thing. Money a company earns from selling goods and services to its customer. That's your revenue. Expenses a company incurs while selling goods and services. Costs, expense. This thing is also called the basic accounting formula. Profits are the reason that investors invest. Investors, which also include the owners, so you can have more than one owner in a shop or whatever. They include founders, partners, shareholders. These are people who risk their money in a business. So why do people deserve profits? Well, that's a good question, and it's often asked. It rewards business owners for producing goods and services. It compensates them for assuming risk of ownership. So you always have bad days, you have bad years, you have people who don't pay their credit card bills, all these type of things. So that is where you need extra money just to stay in business. And then the question is, they say that employees lose a job, owners lose their shirts. Well, would you gamble if that was the deal? I mean, no, business is a gamble. And if you could never win, but only lose, would you ever play that game? No. So there has to be a reward in business to play the game, to take the risks. And that is what profit is. So we're going to discuss risk more later. It's another one of these ultra important things that frankly does not get discussed enough in business. Not-for-profits. Well, these companies exist for reasons other than profit. And they account for a lot of activity in the United States. So about 6% are non-government. Those are people who are unrelated to government, and 38% are government. We'll go into more on that later. Government is usually the largest not-for-profit group in every country, just fact of life. They fulfill functions that are not profitable. So, for example, disaster aid after tornadoes or floods or whatever, or things that you don't really want to be for profit. You don't really want your water supply to be for profit because they can charge you any amount they want. Streets, yeah, you don't really want for profit there either because they become toll roads. Fire, police, etc. I've lived in countries where fire protection was for profit, and in fact, early United States it was. Did not go well. That's why today it is not for profit. Stakeholders are all the different people who are affected by the policies and decisions made by an organization: employees, investors, suppliers, residents. They don't always have to be nearby, but typically they are. Yeah, so this is the end of profits. It's a very short video, but it is one of the most important that we're going to have. You need to review this until you can categorize all of your financial line items as either income or expense. And you need to not fool yourself with that. Okay, so next video.